So we're still looking at Form 941 deposits. We just finished in the previous section looking at monthly and semi-monthly depositors, the timing. But here we have a situation now with shortfalls. What if not enough has been deposited? So monthly depositors remit a shortfall with their next 941. Semi-weekly depositors remit a shortfall by the earlier of the Wednesday or Friday that falls after the 15th of the month following the month of the shortfall, or the 941 due date, whichever is earlier. There are no penalties or interest if the shortfall does not exceed the greater of $100 or 2% of the liability, and the shortfall is deposited in a timely manner, according to what's listed before this. So here we've got on May 5th, a monthly depositor, Freco, discovers that its June 941 taxes deposited July 15th were short $95. Well, Freco can avoid penalties and interest by paying the $95 by July 31st, the due date of the second quarter. All right, and the second quarter would have been April, May, and June. July 31st is the due date, so the shortfall, as long as it's paid by that due date of the second quarter. Now, keep in mind, as a caution, the IRS discourages casual use of the shortfall procedure. It really is not designed to be a normal reoccurrence. It is for unusual cases where estimates are required or there's an occasional error. Now, semi-weekly depositor Red Eye Inc. discovers its 941 deposit for the period ending Friday, May 22nd, was short by $178. That is 1.75% of its 941 liability for the period. Well, because the shortfall is less than 2% of Red Eye's 941 liabilities for the period, then the company can avoid penalties by depositing $178, the shortfall amount, by the first Wednesday or Friday after June 15th. Because this is May, you have until the 15th month following the month of the shortfall, so that makes it June 15th. And it has to be by the first Wednesday or Friday after June 15th. Now, we have what is called the one business day deposit rule. An employer that incurs a 941 liability, so that's federal income tax, that's the Social Security, Medicare for both the employee and the employer matching. If there is a tax liability, taxes, not gross earnings, tax liability of $100,000 at any time, then that employer must pay in its 941 taxes within one business day of reaching the $100,000 tax liability. Once the one business day deposit rule is triggered, then the employer becomes a semi-weekly depositor for the remainder of the year and remains a semi-weekly depositor in the following calendar year. So here we have a recap of 941. Form 941 is referred to as the employer's quarterly federal tax return. So January, February, March is filed by April 30th. April, May, June, filed by the end of July, July 31st, the month following the end of the quarter. Well, this 941 form reconciles the wages paid and the employment taxes withheld or owed with the amount of tax deposited for the quarter. And each quarter's 941, as I said, is filed at the end of the month following the end of the quarter. Now, If deposits are timely made and for the full amount, due date for the form is extended 10 business days beyond the end of the month following the end of the quarter. But the deposits, the money has to be made according to the due date. All right, quarterly employment tax periods. We have the quarter ending March 31st, so that's January, February, March. Filing and deposit due date is the end of the month following the end of the quarter, which is April 30th. Same thing here. You've got December 31st, that would be October, November, December, those 3 months. And you would have till January 31st of the following year to file the 941 form. All right, so that's the due date. Now, we're looking at FUTA tax. And FUTA tax, we need to look at Form 940. This is another federal form. FUTA is the Federal Unemployment Tax Act, and it's paid by the employer, not the employee. It is paid to the federal government. It helps to fund the various state unemployment benefit programs. Generally, an employer pays FUTA tax if it pays wages of at least $1,500 in a calendar quarter, or if it employs at least one person for some part of any day in 20 weeks during the current or previous year. Don't forget, the state laws will typically have their own SUTA, or they're calling it SUI, State Unemployment Insurance, but it's based upon the state unemployment tax legislation. We're just not getting into the various states. Now, the FUTA tax rate for 2013 is 6% of the first $7,000 of each employee's taxable wages for a calendar year. So the employer's not going to pay federal unemployment tax on each employee for the entire calendar year. They're going to be tracking cumulative earnings for each, and it's on the first 7,000. So it's possible some employees who are highly paid will reach their limit within the first quarter of the year. Others working part-time or hired late in the year, those taxes will be paid later in the year. Employers are generally entitled to a maximum FUTA credit of 5.4%. And when you take the 6% less the 5.4%, then that net FUTA tax rate is 0.6%. At the decimal, that's 0.006. And some states took loans from the federal government to pay unemployment insurance benefits. And in states that have not repaid the loan, those employers within that state may lose part of the maximum 5.4% FUTA credit, and then they will have to pay more than 0.6% of the FUTA wages. Now, Form 940 and FUTA tax due date. Employers that have deposited all the FUTA taxes on time and in full during the year have until February 10th of the following year to file Form 940. All right, so they were given 10 extra days if they've deposited all their taxes on time and in full. And so this is a deadline for filing the annual Form 940 to report federal unemployment taxes. Employers paying FUTA tax higher than 0.6% as a result of unpaid state loans must pay the additional tax by the following January 31st. And if the FUTA tax liability for a quarter is over $500, tax must be deposited before the end of the month following the end of the quarter, even though the 940 is not due then. So we're looking at the tax liability. Again, this is not the gross earnings. This is the tax liability, and it's FUTA. So if the first quarter turns out to be over $500, that must be paid before the end of the following month. So January, February, March would have to be paid by April 30th. $500 or less, the liability can be rolled over, it can be accumulated to subsequent or following quarters until it exceeds $500. At that point, then a deposit will need to be made. If it doesn't reach the $500, then you have until January 31st of the following year to make the money deposit. Now, FUTA tax must be paid electronically via EFTPS. There is an exception. An annual FUTA liability of up to $500 may be paid by check, debit, credit card, or EFW, electronic